To the February 2026 Winnie Lake SV event. Months are flying by, years are flying by. Very excited, Don and Bob. I've been reading all the newsletters. I'm like, oh my God, we better gonna pack it in this month. But over to you, Don.
Oh, thanks so much, David. Yeah, it's been a crazy month. Probably got more here than we can go through. I was sitting trying to take out a few pieces, but let's dive in. So the month of January, 30 billion, just over 30 billion in startup funding, Silicon Valley startup fundings.
Wow.
Now I gotta move back for just a moment because at our last meeting, I did not have our final totals. We ended up 208 billion for 2025.
That's amazing. And you're gonna share your screen, Don, right?
Oh, it's not shared?
So it's not. So I'll upload it in there, I figured.
All right, how about now?
Not yet.
Yep, it's coming. There it is. Now we're good.
Okay.
All right, starting over, guys. All right, so startup funding I'm still not getting the full screen here, am I?
Let's get.
Can you see everything?
Yep.
Okay, I'll just go. All right, so startup funding, again, 208 billion for 2025. A new high for us. The very, very frothy 2021 only hit 123 billion, so we are way above that for 2025. And we've started out in January at a level that if we stay at the same level, we'll break the 208 billion for the year. So I'll be tracking that each month on this. You can see where our first month ended up at 30 billion.
There.
Okay. I'm having a problem here, David. Give me just a moment. Page down.
Well, she's saying it's all AI. Everything's AI.
Sorry, Don, you're having issues?
Yeah, I'm having a problem advancing. My apologies. Give me just a second here.
Maybe hit present up top, and then I think that'll give you the ability to. If you set present,
I'm on the right. I'm going to stop sharing and start sharing again.
And Gamma probably likes the arrow keys more than the cursor.
Yep, exactly.
All this money is coming from AI, folks.
There we go.
Okay, let's try again here.
What do you know?
We went way over it that time, didn't we? Okay. So I'm disconcerted here. This is back up. Okay, so I saw this graph and I thought it was interesting. I thought I'd share it. If you get a sense for the Bay Area as being foundational in startup funding, you'd be absolutely right. Out of 2025, more than half of funding went into the Bay Area. That's San Francisco, San Jose, Oakland, but that area took in 732 of the deals. The PitchBook tracked 47 billion. It is a remarkable share. New York is the only thing that comes close, and even there we're talking just a little over half of what you see in the Bay Area. And it breaks down so that startup funding, early stage, more accessible around the country. When you get to later stage, the Bay Area has it hands down. One other thing that came in from last year that I didn't have access to last time was female founders. We're just going to touch on this briefly because the news is not good. In terms of deal flow, we're lower than we were the previous 4 years, back to 2018 levels. And in terms of the dollars, only 3.9 billion, which is just a little over 1%. Now, here in the Bay Area, we did a little bit better than that. We did about 2.5%, but it still is not what I would call an outstanding presentation. We need more female CEOs, we need more female VCs, and we just have to keep working in that direction. As Bob nicely put it, yes, much of the funding in January was AI. The AI sector, that's AI infrastructure, that's the pure play AI, it is the compute, as well as the frontier, the foundation models, the tools that go around it. The little blue sliver on the other side didn't even hit 6%. Infotech and software is the applied AI. But between the two of them, it took better than 80% of the funding. Biotech certainly got its a little bit there, 6%. But overall, there's no question, deal dollars are being funneled to AI. And large deal dollars. So here's the reason we're seeing so much in terms of dollars going to these deals for AI. Yes, there's big deals in the seed stage, but there are far more big deals going out in later stages. So if you look at median deal size now, which is for later stage, B and after, the differential has just increased dramatically. If you take D and later, these are growth stage. They've got a good base. They're putting lots of money into growing now, and the median on those deals was 100 million. In January, we saw 2 deals, XAI, and one other over $1 billion. And there were a total of 31 mega deals, 31 deals, more 100 million or more, 2/3 of those going into AI. So it's not just a little, it's a lot. The only stage at which deal size is unchanged is pre-seed, and that is largely because of the the prevalence of YCOM companies. YCOM this last year put out just over 600 companies, and of those, about 75% were Bay Area. 2026 in January, Series A graduation rates, they're going to stick around 15 to 20%. Expectations for Series A companies are higher, and that will likely increase through 2026 because as we have more of the AI native companies rolling out, they're doing more with less. And startups aren't just evaluated on their own, where they are and what they do. It's relative. The VCs are looking at all the startups they're looking at. And as more startups are doing more with less, those expectations are going to continue to rise. Okay, and ditto on valuation trends. Valuations just between Q3 last year and the end of the year went from 800. This is later stage. They went from 839 million, 17 million up, 856 million now as a valuation median, right? Median's in the middle, as many above as there are below. We do see 2021, 2022 valuations for companies that haven't reset valuations. That hangover is persisting. And for those companies, we're seeing down rounds, 16% in 2025. And for those companies that haven't raised again, it will likely continue in 2026 unless they've been able to make a big step forward. To the why haven't they raised? They were big rounds in 2021, 2022. These are not as many as we have now, but there were rounds of 100 million, 200 million for some of these companies. So getting back to January, we'll talk a little bit about exits. We talked about money going out to the startups, you know, on the level of 30 billion. Now, the hope is that these companies that are getting funded will eventually exit. And as we've discussed in past editions, exits have been remarkably slow for the last 4 years. Last year, M&A brought some light at the end of the tunnel. It was very strong. We're starting off reasonably in January. So just breaking it down, we had 29 out-of-area companies that local companies bought and paid $5 billion for. 15 local companies were acquired by other local companies. Those were more along the lines of the undisclosed fundings, the small payouts. These were not big deals.
Why do you say a
Finally-
million, Don? Isn't that, you mean a billion there?
No, I mean 1 million.
What does that mean?
The acquisition prices for those companies that were acquired totaled out just around $1 million.
You mean it averaged $1 million or total?
No, total.
Gee, my goodness. I don't know
Yeah,
okay.
that's most of these companies were undisclosed. There was one $740 million acquisition, one $100 million acquisition, and a couple more that were under 100 million.
Well, how can it be a million total? Why wouldn't it be a billion total? I don't get that. You can't have 50.
Oh, my error. You are absolutely right. That should be 1 billion.
Thank you. The other
1
thing,
billion. Thank you,
the
Bob.
the other thing too, Don, is a lot of companies do not disclose their acquisition price, and the reason they do that, they're not proud of it. Believe
Right,
me,
we
if
know
they're
that.
happy about it, they'll disclose it. So
Right,
our numbers are a little skewed that way too. Okay.
right. We report the numbers we can find, but a lot of times for various reasons, they're not proud of it.
Right.
They don't consider it competitive knowledge. They don't want to put it out there.
Right.
They've just taken it as a last resort.
Okay.
So yeah, 1 billion, Bob.
Thank you.
And finally, there were 25 Silicon Valley companies that had a nice exit, totaling for the 25 7.5 billion. There were actually 3 of those that were more than 1 billion, 2 that were just under 1 billion. So that was our M&A exit money for January. And we actually had 2 IPOs. Now, this is a nuanced tale. So we had Ethos going out. They raised 200 million. And they did it at an IPO valuation of 1.3 billion. Now, the gotcha there is that previously they had been valued at 2.7 billion. So again, that's the 2021, 2022 valuation hangover. Now, Bitco did a little bit better there. They actually came up a little to 2.2 billion. Those two IPOs, certainly not a robust IPO market. The two of them went out. There are still, this says 750. I believe it's now over 800. Many companies have filed for IPO and have not pushed through. And there's lots of reasons for that. They don't have a need for cash. They don't want to go out and hit a bad time on the public markets. As a matter of fact, one that we have just gone through, a company that was waiting to go IPO this week pulled back, Liftoff Mobile, because everything took a drubbing this week. Now, on the good side for the companies that are staying private, there's plenty of late stage money for them. And really 2025 and continue into 2026, we saw tender offers in which employees can sell some of their shares and get some liquidity now. Don't have to wait to go public. That's pretty widely accepted now. It has not been in the past. Probably 80% of the companies that have done late stage rounds in the last 6 months have also done a tender offer, either at the same time or close to it. And those tender offers are great for secondaries, which are other investors coming in to buy existing positions. And it gives the employees, the founders, and quite frankly, the investors and their LPs a chance for some liquidity, where the IPO may not happen for quite some time. And this goes back to what we're now experiencing. 2025 really solidified this. There's more wealth creation in private companies now being done in the private market than in the public market, because companies aren't going public at any place near the rate that they did. 2021 was the last time that we had a robust market. By the end of 2022, it was gone.
Hey, Don,
Yeah, Bob.
before you leave that, would like to say one thing.
Please.
There's not plenty of money for everybody. If you're a really good company, there's probably a lot of alternatives. My reaction is there's so much money coming in to AI that all these companies that were hanging around as C, D, and E, and have God knows F round companies who always go back to the trough to get money. A lot of those companies, unless they're really robust, are not going to get money. They're going to have problems. They're going to have to devalue, their value. They'll be marked down, if you will. But if you're, because of AI. But if you're a good company, of course, there's lots of opportunities.
Yeah, absolutely right, Bob. It comes down to the quality of the company, how they're doing. I will say that AI, you're absolutely right, lots of money there. FinTech has also gotten many later stage rounds in the last year. But again, there are companies with strong positions,
yeah,
and doing well.
Mm-hmm.
I want to look at the other side of the coin here and quickly touch on the VC side. Last year, VCs raised less money than they have any time in the last 6 years. And that money became very concentrated. 30 of the firms raised 70% of the funds. And these were big funds, $1 billion plus funds. Now, starting this year, just in the month of January, what we saw was Andreessen Horowitz coming out and raising 15 billion. That went into 9 different funds, but 15 billion, which is, believe the figure I saw was 70% of what's been raised over the last 6 months. In addition to Andreessen at 15 billion, we got Lux Capital coming in with $1.5 billion fund. We had Pinegrove coming in with 2.2 billion. Now, after that, it goes down. You've got 5 other firms that came in with funds of 350 million down to 25 million. So even in January, we see concentration of money to the VCs going into these larger firms. It's not a good thing, incidentally, for startups. The more concentrated capital become, that means less competition out there for startups that are raising money. They've got fewer people to go to. And concomitant with this, and we'll talk about this in a moment, emerging managers who are more likely to fund the early stages have had a very difficult time raising. And that goes all the way back through 2025. So last in January, there was a question about how much dry powder is out there. And we generally don't get a figure on this from PitchBook more than once a year. They came out in January with just over 300 million is the dry capital or dry powder figure. Now, dry powder means this is capital that has been committed to the VCs. Doesn't mean it's money sitting in their bank accounts. The VCs will put out capital calls to their limited partners as they need the money, but still, there's 300 million that is waiting to be committed. God, I did it again. Billion, guys. Apologies. And you see here where that breaks down to. Most of that uncommitted is in the last 4 years. What's surprising is how much of the, if you look 2022 and on, is still uncommitted. But this is as of just mid-2025. This is always trailing information. So it is probably significantly less than this at this point in time. We won't know again for another 6 to 8 months. Back to the emerging managers and startups, you're going to be looking for these guys, but they have had a really hard time. This is for 2025. These are first-time VCs, 92 funds for a total of 6.6 billion. It's obviously a fraction of what was raised. Why? Well, no track record. First time funds, so no track record. Overall, an awful lot of the LPs, particularly the institutional, the larger limited partners, have money that's already been invested and they've not received any liquidity back from it. And as a matter of fact, if we take a quick look at, so it's small, it's a little bit hard to read, but if you look at that line going down, that's the net money that's been received back to limited partners and VC funds. So you can get a feel from this as to those limited partners have not received money back on their previous investments. Those folks are not going to be eager to make new investments, and probably less eager with first-time managers who don't have a particular track record to start from.
Hey, Don, let me just interject. I'm going to double down on that. I mean, after all, post-pandemic, all these people, they were seeing all the successes. They wanted to jump in and form these funds. It's really difficult to form a fund, and they're competing with much more experienced people, as you say, with lots of track records. So it doesn't surprise me. And we're talking to a lot of these VC firms anyway, vis-a-vis our relationship. So I mean, it's just very tough for these people to go raise money, period.
Right. And if you look at this line, this is not just emerging managers. This is right across the board, all VCs.
Yeah.
All VC funds. It's a tough time to be getting liquidity back to the people who have invested in you.
Yeah.
And that makes it harder to raise new money, which makes less money out there for startups to get investment from.
There was also a question that came in about, is it because more money is going to angels? You know, there's a whole lot of angel groups out there, tons of them. I don't know how they publish their results or whatever, but a lot of angels are very wary of, because of the economy, all the confusion going on. They can get 5% on a T-bill versus earlier on they were getting nothing on their money. So I think people are very reluctant to be making investments at the earliest stages, and have a lot of requirements for companies they want to invest in. I just think it's a really tough time for small companies early on at the earliest stage, the seed stage, to raise capital, even if they have a lot of AI. In fact, they better have. In fact, every company better have some form of AI that's very foundational. Anyway, just a comment.
Yep, I would double down on that. Okay, bubbles. And we're short on time, so I'm going to talk quickly about 2 of the 3 bubbles, and we're going to go back next month to infrastructure. So if we think about where we are in AI right now, there are a couple of bubbles, if you will, that we're seeing the start of, let's call it the start of deflation. And in particular, around applications. Let's get down here. So if you look right now at the landscape of AI startups, there is an amazing number of startups with huge valuations. We're talking 1,300 that have 100 million plus valuations, almost 500 of them at 1 billion plus. And the number of startups that are going to make it out of the next couple of years, a lot less. A lot of the applications that were first introduced after ChatGPT came out, and in the next 1.5 to 2 years, didn't have a lot of differentiation. They didn't have almost no competitive moat. The companies got them out there quickly, got them out there focused on a particular vertical or horizontal area. And that's a problem for a couple of reasons. One is the next time they need to go back for funding, there are new companies out there now that have done more, that have differentiated, that features, customer acquisition, many areas in which the companies that are now coming out and raising their Series B can take, quite frankly, customers' market share from the first round. Ones that came out with wrappers, if you will, everyone remembers that term, I think. You took ChatGPT, put a little wrapper around it, sold it. A lot of those companies are actually gone. They did not survive the second round of funding, did not make it to a Series A. Another problem, and concomitant with the thin differentiation, they have not built in enough stickiness to make it hard for customers to switch. And there is such a flood of application vendors coming out, new apps, literally on a almost daily basis, and certainly monthly into particular verticals. Customers have a low barrier, low cost to switch, they will, if they see it advantageous. And the third area, hope everybody saw OpenAI's announcement yesterday about their frontier. You can now put together an agent to do very close to what an awful lot of the startups I've seen come out in the last couple of months. Build your own. And that is only going to continue. We also see this from Anthropic, but not to the extent that OpenAI is doing it. They've they have to bring in revenue, and they have to bring in a lot of it. They've got 1.4 trillion in commitments they've made. So they have said they're going to go after the compete with LinkedIn employment market, social network market. They have a biotech group going out there. This frontier model is absolutely horizontal enterprise. But if you're building on OpenAI and you are now competing with OpenAI, that's not a good thing. And we're going to see a number of those companies disappear from the front as well.
Hey, Don, before you leave that slide, I just want, am I correct? Aren't those results for the whole country? Those aren't Silicon Valley results.
Those are the results for the whole country, but
That's what I meant, but I mean,
yeah,
to
for
clarify,
VC dollars, you're competing with the whole country. So
yeah, just to clarify, this is not our own data. This is the whole.
no.
Pitch book or something else. Okay. Thank you.
Now, the other area we're going to see, again, this is just going to be fallout, is the models, frontier models, foundation models. This is all local. This is not the whole country. This is not the whole world. This is just in Silicon Valley. And I only took a slice going back for the last 2 years. But you can see the number of frontier models. The frontier models, these are the most expensive ones. They're the leading edge, the trying to come up with AGI. All these companies have funding in excess of 100 million, most of them in excess of 1 billion. Then you look at foundation models. And the foundation models, they're not as expensive to build as frontier, and they're typically focused on horizontal or on verticals. But here, you have a ton of them. You have biotech and medical focused, you have enterprise focused, you have physical AI focused. I didn't even have room here for the video focused and the, call them other focused, gaming focused. They're not all going to survive. This is a model bubble, if you will, that we're going to see come down. We're going to start to see acquisitions, whether that's of talent or of the companies. In the reverse acquihire model, don't know. We'll have to see. But for sure, this is going to be reduced significantly in the next 3 years. And what we'll talk about next month is the infrastructure piece, because just in the course of 30 days, what the big tech, Amazon, Google, and OpenAI, Microsoft, Google, have almost doubled what they committed to putting into infrastructure for next year. So we'll try and break that down more. And that is another area that I think we're going to see some fallout from in the next year. Maybe for the good over a longer period, but boy, lots of money going out in the short term. Okay, so everything we talk about here comes from the research that Bob and I do for Pulse of the Valley, our weekday business roundup. It's fundings, it's exits, it's what investors are doing, and the executives moving from company to company and VC to company and back again. All of that information goes into our database. We've got 25 years plus of business activity, tens of thousands of fundings, companies, founders, investors, and most of them come with emails and contact information. We try to provide that at very, very low cost to entrepreneurs. We want to do everything we can to foster their success and help them along. And we do a once a month webinar towards that. And we're also now getting into helping startups with outsourced development and in some cases, HR assistants. But talk to us for more information on that. And on that note, David, I will turn it back over to you.
Thank you, Dawn. Yeah, and thanks everybody. If what we'll do, we'll go right into breakout rooms, and then if anybody has any questions, we come back. We'll have some time for that. So here we go.
Thanks for doing this, Don.